Hello, how is it going? It's Jules. Welcome to my segment and of course to our channel, Investing Wise Academy. Today, there's something called a refund portfolio or lazy fund portfolio, which is designed for lazy people and is beginner friendly, low cost, and diverse, which are all qualities we seek. It's simple, hands-off way to invest as a beginner that has historically produced incredible returns, and it's something that anyone can do. So let's talk about 3 fund portfolio in this video. We're going to talk about how those various funds might look. We'll discuss various allocation percentage as well as tips and general information. It's pretty straightforward. It's made up of 3 asset classes, all of which are typically low cost. It's usually made up of index funds or exchange-traded funds or ETFs. But first, if you enjoy videos like this, please subscribe to our channel. The 3-fund portfolio is made up of 3 asset classes. An asset class is essentially a type of financial instrument with similar financial characteristics and market behavior. We're talking about 3 asset classes: US stocks, international stocks, and bonds. These assets are typically made up of low-cost index funds or exchange-traded funds. If you're unfamiliar with the term, an index fund is essentially a large basket of stocks. So instead of buying one individual stock, say you want to invest all your money in Tesla stocks and Tesla's performance suddenly deteriorates and the stock price falls, you lose all of your money. The beauty of an index fund is that it spreads out those $10,500 across a variety of stocks. There are various index funds, such as the S&P 500, which tracks the index and is essentially a weighted index of the top 500 publicly traded companies in the United States. These index funds are clearly diverse. The 3-fund portfolio is based on the Bugleheads book. The Bugleheads are named after Vanguard's founder John C. Bogle. Let's look at some of the reasons why it's beneficial and potentially beneficial to you. So, what are my personal thoughts on investing? I enjoy considering what gives me the best chance for the least amount of risk. I'm younger, at 25, and thus can afford to have more risky investment than someone in their 50s who is nearing to retire. I am attempting to determine what level of risk is appropriate for me. As I previously stated, this 3-fund strategy provides excellent diversification. Instead of picking individual stocks, you can invest in thousands of them all at once, ensuring that your portfolio is well diversified across the platform. And because you're only focusing on 3 funds with strategy, it eliminates the difficulty. You don't have to be concerned about being overly or underly diversified. Diversification makes it simple for passive investors to leave their assets in those funds and forget about them. Take a breather. Please don't touch it. Allow it to sit for a while. This is a great strategy over time because it is generally low cost. It's a different approach if you want to be more hands-on with your investment and more interested in diving in deep and investing in individual stocks. There are only 2 steps to creating a 3-fund portfolio. You can choose to be more aggressive or conservative when selecting your funds and allocation. As I previously stated, it makes more sense to be more aggressive when you're younger because you have more time in stock market, whereas as you get closer to retirement, you'll be taking some of that money out. You need to be a lot more cautious. Now that we've defined index funds, let's define bonds. A bond is a fixed income security issued by a lender to a borrower. Because it is frequently produced by a large corporation or the government, it is known to be extremely safe and predictable. You have the option of investing in US stocks, international stocks, or US bonds as I previously stated. The most popular US stock fund is probably VTSAX, which stands for Vanguard Total Stock Market Index Funds. The VTIAX or the Vanguard Total International Stock Fund is a popular international option. There are several types of bonds to choose from. VBTLX or Vanguard Total Bond Market Fund is one of the most popular. You can also find the ETF equivalents for these. As I mentioned earlier, you'll be tracking the domestic US stock market, the international market, and a bond fund in this refund portfolio. What is the best allocation? So keep in mind that there is no perfect answer, no one-size-fits-all solution. It is highly dependent on what works best for you, the amount of risk you want to take, and how volatile you want your investment to be. The main factors to consider are age, time, and risk, as I mentioned earlier or earlier in life, so you know what age you are now, how long do you plan to be in stock market, and how much risk you want to take. Honestly, if you have a bit more risk appetite, which isn't as high as investing in individual stocks, you might consider it. So an 80-20 allocation is considered riskier, whereas a more equal allocation is considered super mid-tier. So I'd say 33% domestic stocks, 35% international stocks, and 33% bonds. And then there's the 20-80 approach, which is considered extremely conservative. So it all depends on where you are in life. So within this percentage, bonds are usually the element that depends on how volatile you want your investments to be. Bonds are known for being extremely stable, so the more bonds you have, the lower risk your investment has, and vice versa. The riskier your investment, the better, but when you're younger, you want to be more active in the market to help build your wealth over time, whereas bonds are something you want to use later in life. Going back to our friend Mr. Boogle's book, he recommends for younger investors something like an 80-20 split, which means 80 in stocks and 20 in US bonds. When it comes to the 80 stocks, that's when you have to figure out your percentage breakdown between US domestic stocks and international stocks. Again, it's personal decision to investigate it. I look into Vanguard Target Fund and what they do for a more expert approach. Its 2050 Target Date Fund invests 54% in US stocks and 36% in international stocks. I believe I know the US market better than the international market, so your number for US stocks may be higher, but the breakdown is entirely up to you. I was researching how to determine a good allocation on the internet. There's a method that involves subtracting your age from 110, so I'm 25. If I subtract it from 110, I get 85% invested in stocks and the rest in bonds. Because I'm younger and willing to take more risk, I'd say 90 to 95% goes in stocks. That's all there is to the 3-fund portfolio. It's important to remember that this is a long-term endeavor. The goal is to accumulate wealth over time. It isn't about becoming wealthy quickly. It's about consistently investing money over time and then withdrawing it years later. This will allow your money to grow over time rather than simply sitting in your bank account where it is losing value due to inflation. Put your money to good use. I believe it is important to remember to set some clear goals for yourself. For one thing, when I have a goal in mind, whether it's buying a house or a car or planning a wedding or whatever, you're more likely to save and invest your money. You should consistently contribute to these long-term investment strategies because they are only as good as the money you keep putting in. Also, if you want a dollar cost average, it rather than putting all your money in at once. That means gradually putting your money in over time to make sure you're hitting all of these different points. That's an approach depending on where the market is, but by adding it consistently, you'll keep expanding your wealth over time and it will keep growing with this positive historical rate of return. The old adage goes that being on time in the market is preferable to trying to time the market. It's preferable to simply resume investing in stock market. There are numerous options for investing your money, so do your research. Hopefully, this was helpful if you were cautious about like how do I take that next step with investing and like where do I actually put my money. Those are some popular funds to look into as part of popular approach to breaking down the money you're ready to invest in the stock market. So if this video was helpful, I'd really appreciate it if you gave it a little thumbs up and a little comment. Make sure to subscribe so you will never miss another investment tip from us. Again, it's Jules, your host. See you soon in our next video.